Before investing any money in property, it's worthwhile understanding whether the type of building you're thinking about investing in is actually going to make good financial sense or not. And there are 4 steps that I'm going to set out for you, which can provide you with a strong indication of whether the building you're thinking about is a sound investment. I'm going to call them market indicators. There are 4 of them. I'm going to run through them now. Hi, I'm Edward. I'm a chartered surveyor and I've worked in property for over 20 years now. Most recently, I was head of investment finance for a property division of a FTSE 100 listed company in the City of London. And I've also been an associate lecturer teaching real estate investment finance and commercial property valuation at Oxford Brookes University. So hopefully I've got a good blend and balance of theoretical and practical knowledge that I can share with you to help your property investment journey go a lot more smoothly. Okay, so if you're serious about making a direct investment in property, whether it's residential, commercial, forestry, or any other land-backed asset for that matter, there is a point in that acquisition process where you will inevitably have to spend money. That might be on solicitors' fees, that might be on a surveyor's valuation, it could be on a building survey. You name it, there are a whole host of things that you're going to have to spend money on. But best practice for an investor is to delay and postpone spending any money until you really have to, because very often property acquisition deals fall over. And so if you're spending money ahead of the acquisition, chances are you're putting a little bit of your capital at an unnecessary risk. So if you can do a little bit of work up front that doesn't cost you any money at all, but gives you valuable insight into the type of investment you're thinking of making, then that's a really good idea, right? So I'm going to share with you now 4 high-level market indicators that will not only help you understand whether the building you're looking at is a good idea for an investment or not, but will also begin to open up really valuable channels for you into your property community in your area or in the type of building that you're thinking about looking at. I haven't put any of these 4 market indicators into a particular order, but for me, priority must be given to market indicator number 1, which is demand. It goes without saying that to be effective in investment, the building has to work for you. For a building to work for you as an investment, whether it's a residential building or a commercial building, it has to be occupied. You have to have tenants in there, and those tenants need to be paying you rent. So you're looking for a building then that has a high occupier demand. In other words, imagine your building in a pool of tenants that all want to occupy your property. Now, it could be that the building you're looking at actually has very low demand, but by making a couple of tweaks to it, like refurbishments or some form of change of use or redevelopment, you can actually attract a whole different set of tenants or occupiers, and you could actually manipulate that occupier demand situation. Now, that's already a rabbit hole. It's far too early in this video to go down rabbit holes, but that's going to be a video for another day. Right now, let's just stick to the basics. Let's go on the premise that you're looking at a building and you're not planning on making many changes to it. So how do you find out about occupier demand without spending any money at all? Well, the first step you take is you jump in the car, you look at the building you're thinking about investing in, and then you drive around the local area and look for similar properties. Specifically, you're looking for estate agent or surveyor signboards on those properties, either declaring them to let or for sale. This is where common sense comes in. If you think you're seeing quite a lot of buildings that look like the one you're thinking about investing in, with a to let board or a for sale board on the outside of them, then chances are that supply demand curve is tipped against you. It looks like there's probably a little bit too much of the type of property you're thinking about investing in the market at the moment, and not enough occupier or tenant demand. At this stage, just take note. Don't let it put you off completely. because the next thing you should do is speak with commercial surveyors in your region or that specialise in the type of property you're thinking about investing in. If you're stuck on how to find those commercial surveyors, then hopefully what I'm about to share with you is useful and a good way of finding surveyors that should happily speak to you on the phone and give you a little bit of an indication about the strength of the market for the type of property you're thinking about investing in. So I'm going to cut away from this video now and I'm going to show you how to find commercial surveyors. Do a Google search for RICS and you'll land on the RICS website. At the top right hand side, go to Find a Member and then move down the page and click on Find a Surveyor. Now in this example I'm just going to pick a random town, so I'm going with Ipswich. And we can see that for Ipswich and every other town in the country, you get a list of surveyors working in that area. And on the right hand side it will designate whether they are a commercial or a residential surveyor. So that is the RICS website. Just as a side note, if you're thinking about residential property, it's usually far easier to get the information you want on tenant demand by contacting local letting agents. In all cases though, it's absolutely crucial that you pick up the phone. I don't recommend email. I really do recommend picking up the phone, perhaps even having a coffee with one or two of these experts in their field and really working with them, asking them about tenant demand for the type of property you're thinking of investing in. By doing that, by speaking to these experts, you are establishing your contact network in the property investment space. You know, it really is a communication-based industry. So get chatting, get talking, build that network. Market indicator number 2 is financial stability. This is going to be covered in 2 quick sections. The first one is a little bit woolly, but it is psychology. Your psychology, you, the investor, you need to have an affinity with or a certain degree of enthusiasm for the type of building you are thinking about investing in. Because no matter what anyone tells you, property investment is not passive. You will need to be involved in decisions pertaining to that property from time to time through the year. And so what's that got to do with financial stability? Well, if you think about it, if the type of property you invest in is likely to attract a type of tenant that has, shall we say, a weaker financial profile than another type of tenant, then chances are your involvement with the property directly is likely to be higher through the years that you own that property, because you're likely to see more turnover of tenants in your building. The type of building you choose will attract a tenant that has a specific type of financial stability. And that really is common sense, and that is you looking at the building and thinking, who is likely to occupy that? Then look at neighbouring buildings. Look at the occupiers in neighbouring buildings that are similar to the one you're thinking about buying, and think to yourself, okay, are they established businesses? Do I know my local market? Has that business been trading there for years, or is that building constantly cycling through tenants? You can then begin to build a bit of a picture about the likely tenant stability or financial stability of the building that you're thinking about investing in. Now, I said this would be in 2 parts, and the second part of this is far more practical, and it is around background checks. If you buy a building that is, say, £500,000 plus, it is likely, I hope, that your rental income from that property will be substantial each month or each quarter. And so therefore, it is probably worthwhile at a specific point in the process of working with a new tenant coming into your building that you undertake a robust background check. Now at this juncture, I can recommend this company, Kroll. I think they're absolutely fantastic. I have used them myself. I have absolutely no affiliate link with them. I have no financial relationship with them. I'm recommending them just because I've got past experience with them and they do brilliant, very, very detailed background checks on key individuals and businesses. For smaller buildings or buildings with a value of less than £500,000 that are likely to have an associated rent roll that is sort of on the lower end of the spectrum, it makes no sense at all to pay for an organisation like Kroll to do background checks, not unless you want to be really, really diligent. But you're going to need to factor the cost of that check into your financial performance analysis for that building. There are, of course, lower cost background check options, which you can undertake through subscriptions with Equifax and Experian. You can subscribe to that can do due diligence and background checks on tenants that are potentially going to occupy your property. I think the point here that I want to stress is that do what you think is necessary to give yourself peace of mind and comfort as far as is possible to ensure that the tenant taking occupation of your building is financially sound, because voids, vacant buildings, are a bit of a pain in the neck and they completely defeat the point of property investment. Alright, so let's move on to item number 3. Market indicator number 2 is financial integrity. For those of you that want to understand this point quickly and then skip to the next section of the video, financial integrity is important and summarised as follows. The type of building you invest in needs to attract tenants that are financially strong enough to be able to stay in occupation for the entire course of the lease, pay you the rent that you ask for, and pay you that rent when you ask for it. That is property investment 101. That's it in a nutshell. That's perfect property investment. But it is a little bit more nuanced than that. So I'm going to go into a couple of areas that are worthy of consideration. And I'm going to explain them as quickly as I can. But I'm now on take 22 of this particular section of the video. And so, yeah, what I'm about to say is a little bit of a challenge, but I'm going to get on with it. Let's do this. Right, so the first thing to consider when it comes to financial integrity is your psychology, your mental preference as an investor. What type of building and therefore what type of tenant do you have most affinity with? What energizes you? What interests you most? That's a really important consideration, because through the entire length of you holding this property investment, you will, whether you like it or not, have to make managerial decisions and communicate with people about that property investment that you've made. No matter what people say, property investment is not passive. So you're either going to be communicating one-to-one with your tenant or via a third party, like a managing agent or a letting agent or a firm of chartered surveyors or a solicitor for some sort of business that you need to get done. That will be fairly constant through the years that you hold the investment. So what's that got to do with financial integrity? Well, it has a lot to do with financial integrity when you consider that you can deliberately pick a type of investment that piques your interest. So, for example, it might be that you've made money in business and you like the idea of supporting and working with new startup businesses. So it could be that you invest in a string or a row of small light industrial units or a commercial office building that's been subdivided into small compartments. Both types of buildings suitable for startup business enterprises. And that can really energise you. And it will need to energise you and it will need to keep you interested, because it's highly likely your involvement will be a little bit higher than other forms of property investment. And the reason for that is financial integrity. It is likely that the tenants in those types of properties, business incubation units, will go bang on a more frequent basis than, shall we say, more established businesses. Startup businesses are prone to fail. That will impact you because you will have vacant units in your investment property. Vacant units need to be marketed. Marketing comes with a cost. Marketing comes with a correspondence requirement between you and your managing or marketing agent, so you can see it's a little bit more involved. Whereas on the flip side, a much larger unit, like a logistics hub that would be occupied by a supermarket or a supermarket distributor rather, or Amazon or something similar, may well be vacant for a long period of time, but actually once you have a tenant in occupation, they've made a substantial business decision. They are probably quite a big, robust organisation, and they're more likely to be there for the long term, paying you rent on a more reliable basis. So you can see the different types of property that you choose to invest in will require different types of energy and different types of enthusiasm. And all of that links back to financial integrity, because if your tenants don't have that financial strength and security, chances are your engagement with the property is going to be that much higher. Market indicator number 3 is marketability. And this is where all of that experience that you gained from buying your own domestic property that you live in now can be transferred across when you are considering an investment in commercial or a investment residential property. And what I mean by that is all the buzzwords come out. Everything that you heard from the estate agents, like location, condition, size, all of that stuff becomes important at this point. Let's look at that in a little bit more detail. Put yourself in the shoes of the tenant that is either in occupation of the building that you're thinking about investing in, or a tenant that would be likely to occupy the building that you're thinking about investing in. Go to the building and drive around the local area. Ideally do that more than once. Something to look out for might be deliveries, for example. Are there big articulated lorries attending the site, going to that building that you're thinking about buying? Are they able to get there easily, or are they going along lots of different narrow country lanes? Are there signs of damage on the gateposts on the way in and out of the site? All of these things point to small indicators that develop into gripes and complaints and issues when it comes to managing an investment property. And ideally, if you can recognise those right at the start, you can either say to yourself, well, I can remedy that, or actually, I'm going to need to get a discount on price because of it, or it's too much of an issue and I'm going to walk away. So, that marketability piece is something that you can suss out for yourself for free by looking at the property, looking at neighbouring properties, looking at the type of occupier and how they use the space. And remember as well that I encourage you to speak with local agents, letting agents, chartered surveyors. And this again is part of that conversation that you're going to have with them. Speak to them about the type of property that you're thinking about investing in, and then ask them directly, what attributes of that type of property do tenants demand in the market today? And you'll be quite surprised about what you hear. It could simply be that certain industrial tenants require a roller shutter door that opens to a specific height and has a specific width, because vans these days are built to different proportions. Or it could be that office occupiers require solar panels or air source heat pumps as their form of electrical supply or heating control, because they need to meet new environmental standards. All of these things will come out in the wash, and what you'll actually develop is a picture of how accurately the building you're thinking about investing in meets the current requirements of the tenant market. What you can then do is get a gauge of how much of the market you are likely to attract because your building does or does not have those attributes that are being sought in the current climate or the current time. What that all then transfers into is if your building is lacking some of those qualities, it means that again, you can look at whether they've been reflected in the price, and if they haven't, you then chip the price accordingly. Or if you can't make up those qualities, it might be that you say, I've had enough and I'm going to walk away from this one. All the while though, this free gathering of information is actually helping you create a really robust picture of the investment market. So it isn't time wasted. If you don't buy this particular building that you're looking at, what you're still doing is framing that image of the market, building a depth of experience and a depth of knowledge and a depth of contact so that you can actually be able to identify better buildings or better investments very quickly and be a really, really confident investor. All right, let's move on to the final market indicator, number 4. All right, market indicator number 4 is the market you are interested in investing in growing? Now this one can be a little bit of a hard one to get your head around, but actually you will begin to see whether a market is growing through the back of the research that you've undertaken for the previous 3 market indicators. So by driving around, and this final market indicator is the market growing? This indicator is the hardest one to identify from the point of view of being an investor in property. It is important, but not absolutely vital when you compare it to the previous 3, which I would say are the ones to pay most attention to. But an investment in property in a growing market is going to give you a degree of tailwind. It's going to make life quite easy. Whereas the flip side, to state the obvious, is an investment in a declining market is likely to be financially painful, or could be financially painful. So where are we going with this? Well, if you consider the UK high street right now, in most towns up and down the UK and most cities up and down the UK, the high street is a very, very difficult place to be for a property investor. Yes, there are trends, call them that, I think it's probably an okay word, amongst a certain class of property investor that supports the idea of buying high street property and converting the space above to residential units, and that's absolutely fine, that's great. But you still have that core commercial asset, the retail unit on the ground floor, which potentially could be troublesome and serve as some sort of drain. So regardless of the strategy, and I hate that word with property, but fucking hell, Edward, get on with it. Number 6, take 6. Number 6, take 6. So finally we come on to the indicator number 4, which is the market growing? And this is quite a difficult one to ascertain if you are an investor. And I would say, compared to the previous 3, the least important one. Do pay it some attention, but actually focus your energies, if you only have the time to do so, on the previous 3 market indicators that I've just covered off. So growing markets, quite hard to spot. Whereas on the flip side, okay, take 7. Take 7. And this final market indicator is growing markets. Look for and invest in growing markets. And of the 4 indicators, I would suggest that this one probably carries least importance when compared to the previous 3. So if you've only got the time and energy to do the previous 3, that's absolutely fine. But just be aware that when you want to target a market that's likely to be growing or should be growing, you definitely want to avoid a market that is falling and failing. Because a failing property market is difficult and likely to be a financial loss. And that is in no small part because property is an illiquid asset. It takes a hell of an effort to actually acquire it, it takes a long time to acquire it, and it takes a similar degree of effort to dispose of it and remove your cash exposure. So if you think about it, if the market is failing, it's going to take you even longer to liquidate your position and get your cash out. Now, these are very, very obvious points to make. I think it would be helpful if I maybe threw out a few of my own ideas with regard to growth commercial property markets. And so some of those that you might want to look into or consider would be specific light industrial units, potentially new build light industrial units, between 800 at the very small end through to about 1,500 square feet, potentially with some form of office accommodation upstairs or mezzanine upstairs that can serve as some sort of administrative or office space. Those buildings tend to be quite attractive, and as long as they're in a good condition, in quite high demand from an occupier perspective. Another market which I believe is growing or just continues to be strong is commercial forestry. We are net importers of timber here into the UK, and subsequently I really like commercial forestry as an investment class, and it's something that personally I'm planning on getting into a lot more over the next few years. And finally, and this one again needs to be carefully picked, but it does look as if the work from home trend that we saw really increase during COVID is just beginning to be reversed to some extent, and that the use of office space will begin to increase. Now, that's not to say that all office space will be in demand, but certainly offices that are in attractive locations, potentially with good walk scores, so it can be accessed either on foot or via public transport or on a bicycle, for example, that sort of office space could actually be a solid investment. But quite a little bit of research we needed there. So remember those telephone calls I encourage you to make. Those would be particularly important if you're considering an investment in office space. So there we are. There's a few examples of what I believe are growth markets. That is not investment advice, by the way. Please do undertake your own due diligence. I hope you found those 4 market indicators helpful. If you've got any questions, please do pop them in the comments section below. My email will also be in the description below this video.